Here, in one of your notes, you note that mortgage volumes are likely to be materially lower. I don't think that's going to be breaking news to anybody, but how material is materially lower?
No, absolutely. Firstly, thank you so much for having me on today. In terms of mortgage volumes, we rely on the market indices, particularly the Mortgage Bankers Association, Fannie Mae, Freddie Mac. We've looked at some of their estimates, and in general, last year they had estimates of 4.3 trillion for the mortgage market size. This year we're looking closer to 2.4 trillion so far, and there's some risk to the downside, I think, on those numbers too. So we're talking about a $2 trillion cut in the total mortgage market size.
Can every company that's public that you cover survive that, Mihir? I mean, do some of these companies have to consolidate or go to zero?
We've certainly seen that. We've certainly seen some consolidation already happening. Certainly, you look at the way a company like Home Point is trading. There's certainly some other public companies out there too, which you're seeing real risk, if you will, being priced in off these types of the kinds of scenarios you laid out. That said, there's certainly companies like Rocket out there which have a very strong liquidity position. We think a lot of them will survive. It's a matter of how long. That's the real challenge here, is how long these kind of conditions last.
Yeah, I mean, there's going to be long-term survivors, Mihir. And if you're an investor in this space and you're thinking 10 years out, okay, we're going to have a rough couple years maybe for housing. Some of these companies may not make it. But you want to buy when things look the bleakest. Maybe it's not the bleakest, but you could tell us if you think it is. Is Rocket, Dan Gilbert's company, the one that wins?
They certainly have advantages. We've pointed out in previous reports, like in the short term, we certainly think the challenges remain, and we, to be clear, do have an underperform rating on them. That said, we do think that longer term that they do have some real advantages on the technology side. We also think they're doing some interesting things where they're leveraging their technology with other players in the mortgage ecosystem, whether it be community banks or through their Salesforce partnership, also through other financial players, like an American Express or a Schwab. We think that can be an interesting play. We certainly like them, as a low-cost player in the space. We like their direct-to-consumer model as mortgages get digitized. We do think they have some advantages. Yep. But again, all that said, I'd come back to, the short term is we're a little skeptical in the short term that necessarily at the bleakest point.
Is this the bleakest it's going to be, or is it going to get even bleaker? I mean, rates are going up. They're not coming down for a while.
Right. And we think that's really the driver of our underperformance rating, what you just mentioned, rates going up. We think there's still a little bit of demand destruction, if you will, to come. We also think that the industry has started to rationalize, but there's potentially room for further rationalization and cost cutting. Until that happens, you're going to continue to see earnings pressured and margins pressured. And competitive intensity is very high still in the industry. So till we don't get to a point of equilibrium where you start seeing some of those margins start improving, it's hard for us to say that we are at the bleakest point today.